Most Forex accounts die from bad execution, not bad strategy. A written plan fixes that. Here's how.
Most retail Forex accounts die for the same reason. Not bad strategies, not bad brokers, bad execution under stress. You set a stop, the market wiggles, you move it. You said 1% risk, then the trade looks great, so you double up. You promised yourself you'd quit at -2% for the day, and at -4, you're chasing it back. None of that is a strategy problem. It's a plan problem. A Forex trading plan is the written contract you make with yourself in calm hours, so the version of you that shows up in volatile hours doesn't get to improvise. The hardest moment in trading isn't picking a setup. It's the first time the plan says no, and you want to say yes. We'll come back to that. First, what actually goes in the document? A working plan has 6 sections: trader profile, market focus, strategy, risk, tools, review. Anything more is padding, anything less is a gap, and the whole thing should fit on 1 to 3 pages, because a 20-page plan never gets opened during a live session. Start with you: capital, time available, experience, goals. The single most common mistake in retail plans is mismatching the strategy to your schedule. A scalping plan for someone who checks charts at lunch is a recipe for missed entries and impulsive revenge clicks. Pick the strategy that fits your real life, not the one you wish you had. Then market focus. 3 to 5 pairs maximum. 1 or 2 sessions you actually trade. London open, New York overlap, whatever fits your hours. And state explicitly which pairs you avoid. Exotics with wide spreads, news event windows. The discipline of saying only Euro US dollar and GBP US dollar during London open is what stops you wandering into a USD MXN trade at midnight with no edge and no clue. That's setup. Now the engine. The strategy section has to be precise enough that another trader could read it and take the exact same trades you would. Enter on a strong move produces nothing repeatable. Enter long when price closes above the prior 4-hour range on Euro US dollar during the first 90 minutes of London open, with stop below the prior 4-hour low and target at 2R. That's a setup. Every rule needs a noun: pair, session, time frame, entry trigger, stop placement, take profit logic, a filter for when to skip. 3 to 5 setups maximum across the whole plan. Beyond that, none of them get enough screen time for you to refine the edge. The reason precision matters isn't bureaucratic. It's that vague rules give your emotional brain wiggle room, and your emotional brain will always use it. The plan only works if it's mechanical enough that "did this trade qualify" is a yes or no question, not a feeling. Then risk. This is the most violated section in every retail plan, and the numbers are not negotiable. Risk per trade, 0.25 to 1% of account equity. Daily loss cap, 2 to 3%. Weekly loss cap, 5 to 6%. Always in percentages, never in dollars, because dollar amounts don't scale and they let you rationalize. Correlation matters too. Euro US dollar and GBP US dollar long at the same time isn't 2 trades. It's 1 trade dressed up as 2. Cap the total exposure. And leverage discipline. Just because the broker offers 30 to 1 doesn't mean you use it. Leverage is for accessing volatility, not amplifying size. Here's the mechanism that destroys accounts: revenge trading. You lose. You feel it. You double up to make it back. You lose bigger. The daily loss cap exists for exactly this moment, but only if you've written down what happens when it hits. Close the platform. Walk away. Journal the day. If the rule doesn't include the action, it won't survive the impulse. Tools and review, the boring 2. Tools first. Name the broker, the account type, the platform, the journal, the alerts, where the platform runs. Vague gear lists produce inconsistent execution, and most bad luck trades are actually missing tool trades. No price alert, miss the entry. No news calendar, blindsided by NFP. No journal, no memory of what worked. Then review cadence, the section beginners skip first and pay for longest. Daily journal after every session. Weekly review on Saturday or Sunday. Which setups worked, which got violated, what surprised you. Monthly review, expectancy, win rate, average R per setup. Quarterly review, is the strategy still right for the current regime? Is the account still matched to the rules? Without review, the plan ossifies. It stops describing how you actually trade and becomes a museum piece. The journal is what turns the plan from a wish list into a feedback loop, because memory selectively keeps your winners and quietly drops your losers. Before any of this touches real money, it goes through 3 filters. Backtest each setup across 12 to 24 months of data. Out of sample test on a separate 6-month period the strategy hasn't seen. Forward test on demo for at least 30 sessions. Then live, at minimum size, micro lots, for another 30 sessions before you scale. The most expensive sentence in retail trading is demo doesn't feel real. It feels real enough to catch the bugs in your rules. It feels real enough to prove you can follow the plan when nothing is at stake. And if you can't follow the plan on demo, you definitely can't follow it with $500 on the line. Document every single trade from session 1, not starting properly next month, day 1. The traders who survive year 1 are the ones who tested the plan with no money before they tested it with real money. Back to that earlier question. The first time the plan says no and you want to say yes, that's the test. The setup looks tempting, but it's outside your defined window. The position would feel better held longer, but your exit rule says close. Every disciplined trader has been in that exact seat. Following the plan in that moment is what makes the plan work. Abandoning it once teaches your brain that the plan is negotiable, and a negotiable plan isn't a plan, it's a suggestion. So here's where to land. Build a 1 to 3 page document covering trader profile, market focus, strategy, risk, tools, and review. Make every setup precise enough for a stranger to apply. Cap risk at 1% per trade and 3% per day, in percentages, mechanically. Validate through backtest, then demo, then micro live. 30 sessions each, journaled from day 1. Review weekly, refine monthly, restructure quarterly. The plan doesn't predict the market, it protects you from yourself.
A written plan protects you from yourself. Full breakdown linked in the description.